who is Senior Vice President and Principal of LCG Associates in Dallas. So gentlemen, thank you for being with us today. Also, I'd like to thank all of the donors that are on the call today. I know we're been through some unprecedented times, particularly if you look at the last couple of years of low volatility and tremendous results from last year. This year's been a bumpy ride so far, and it's probably going to continue. So we wanted to provide an opportunity for you folks to be able to hear firsthand from what our board of trustees listens to on a quarterly basis and interim basis, also in between meetings, because LCG Associates has been with the foundation since 1994. So again, we're very happy to have them here. If you have questions that come up during the presentation, if you just use the chat button and chat your question to the group, and we will answer those at the end. And then second of all, if we get to the end and we have some time, we'll have time for you to unmute yourself and go ahead and ask a question if you didn't get a chance to chat it in. So hopefully that's good with everybody. And with that, I'm going to turn it over to you, Taylor.
Great. Thanks, Matt. And let me, I think I had the wrong presentation in there, so bear with me one second. I had my own version in there, but I will get it in there. And
I was gonna say, do you want me to share, or are you good?
If you have it up, I just need to log back in real quick and switch it over. I
have it up.
You are well prepared.
That work?
Okay.
Perfect.
Well, this is Brian, and first of all, thanks for spending the time with us. We appreciate it. It's always good to talk to everybody. I'm going to give a quick overview of who LCG is. I won't go into too much depth. Like Matt said, we've been working with the foundation since 1994. We've actually been in existence since '73. Taylor and I are obviously in different offices. He's in Atlanta, which is the headquarters of LCG. I'm in Dallas, and we do have a one-person Seattle office. Just quick on the company, we're employee-owned. There's 34 of us. Taylor and I are two of those 34 that own the company. Our focus is mainly on our clients and research. So we have very few clients per consultant, since our job is both serving the client and doing all the research ourselves. From a client standpoint, it's 90 clients, a little over $100 billion in assets. And it's been pretty steady for quite some time. Probably the most unique thing about LCG as a consulting firm is our ability to keep people, which is good, I guess. You see on page 3 that we're looking at our senior staff. Pretty much everybody's been around at least 5 years, and our clients have been around for a long time. The way the firm is laid out, like I mentioned, we're all analysts, so we all do research. So every senior partner, like myself and like Taylor, has to spend time on researching not only the capital markets, but investment managers. You can see on this page we have 40 people doing it. And we've been doing it for a long time. We have a lot of people with very nice designations like CFA and CAIA. And like I mentioned before, the most important part of it is time. And because of that, we limit our number of clients, and we have 6 clients per each consultant at the firm. So what do we do with the Catholic Foundation and our other clients? That's on page 5. This is not all encompassing, but it pretty much covers the majority of it. One, which I think is probably the most important thing to think about, is that we serve as a fiduciary. So all the advice we give and everything else we do is as a fiduciary to whatever assets that we're working with. And in real broad terms, kind of the major things that we would do is work on asset allocation, portfolio construction, manager searches, that kind of stuff. And then review performance, and it's kind of a full circle. You know, as we do that, we come back with more recommendations on managers as we review the capital markets, kind of like we've been doing recently with everything that's been going on with the coronavirus. That's basically us. We can answer questions at the end if there's any other things you want us to cover, but I thought I'd have Taylor walk through kind of the strategy of the foundation, the pools, and the capital markets, and I'll jump in from time to time.
Sure.
Taylor, before you jump in, I just want to make sure everybody on the call knows that this slide deck will be available to you afterwards. We can email this to you, so you don't worry about having to scribble down a lot of notes unless you want to make some other notes that Taylor or Brian bring up. Thank you.
You bet. Sure. So on page 6 here, just the foundation's investment strategy. And, I think a couple key takeaways here. First, we referenced the investment policy statement. This is something we work very closely with staff and with the investment committee. And it's a constant review as this is really the governing document for the foundation. It's a lengthy document, but some of the key takeaways we have here in the bullet points, I think first and foremost is just the long-term investment return kind of nature of the foundation. So certainly very challenging in periods like we've gone through recently, 2008, 2009, the dot-com era, those time periods when there's a lot of volatility, when there's a lot of fear in the market and uncertainty, it does make it challenging. But maintaining a long-term approach and long-term review of managers, is really key. And not making rash decisions, which I know is hard to do. And we have a slide towards the end that talks about market timing and how you miss out on if you try to be tactical and get in and out of the market, which no one can really do. So the foundation's investment is really focused on, and when we get into the pools, it's focused on, balancing long-term growth with also preserving capital. We want to be diversified by asset class, by manager. We certainly want to make sure we're not over diversified. And we'll kind of touch on that in the pools with how they're structured in a few minutes. The last bullet point I think is important as well. Historically, the foundation has had some more, what we'll call benchmark agnostic managers. So, every manager out there, whether it's a large cap growth or a small cap value or international, most managers are really measured against the benchmark. Some of them focus on a benchmark. Some of them, completely ignore the benchmarks and hopefully can provide alpha or returns above the benchmark. But those types of strategies do come with higher tracking error, which means there's going to be greater dispersion against the benchmark, both good and bad over time. Fortunately, being patient and working with these managers over time can certainly lead to positive results, but it does take a little more patience, which the investment committee of the foundation is very good at kind of maintaining the long-term nature of the portfolios. So the next page just kind of hits the pools at a very high level. I think most of you are familiar with these, but if you just focused on the two on the left, the money market and the ultra conservative, these two are really going to be focused on fixed income and cash-like investments. So no equities in these pools. We did include the bottom row there, the time horizon, just for you how you should think about this in terms of time. The money market is really designed for, what we call kind of immediate cash needs. So we would say 12 months or less. It's not worth taking fixed income risk, especially in this market. And you certainly want to move out on the equity curve if you know that money is needed within 12 months. The ultra conservative is more kind of 1 to 3 years. So again, pretty conservative, but as you move out to the right, the conservative, the balance, and the growth, anytime you add equities to the portfolio, just given the inherent, volatility of equities versus fixed income and versus cash, you need to have a longer term mindset. So the conservative, think kind of 3 to 5 years. And then the balanced and growth pools, these are going to be longer term in nature. We have 5+ years here. It's more kind of 5-10 years, if not longer, as you think about those. A couple key points on the bottom. Again, I think most of you are familiar, but the pools have a mix of passive and active funds. Passive being on the large cap side, different asset allocations to meet different return and risk needs. And then I think at the bottom, the fees is important as well. So we're really able to use, institutional mutual funds here. So these are vehicles that have, $1 million minimums, $3 million minimums in some instances. So being able to leverage a lot of the managers that the Catholic Foundation uses in other areas of the foundation really benefits everybody in these pool structures as well. So what we thought we would do next, and there are a lot of slides in here. I promise we won't hit on all of them, but just talk about the markets in in a couple key aspects, and then we'll dive into the pools and the managers of the underlying pools as well. So page 8, this most of this data is going to be as of April. So we tried to look past the first quarter, which was very challenging. But the story really so far this year has just been the rapid decline in the markets. If you look at the peak to trough there from February 19th to March 23rd, the S&P was down over 34%. But since then, through the end of April, it's recovered about 30%. So we've seen a very strong move down, but also a very strong, recovery. When we talk about some of the April numbers in terms of performance, fortunately, there's been a lot of managers that have, gained a lot of returns back in a very short period of time. If you jump ahead to maybe just page 10, and we'll look at volatility, as Matt mentioned, if you look at the top chart, if you look at 2016, 17, 18, 19, we have been in a pretty low volatility period, in terms of the market. So I think investors have, gotten used to that. Whereas volatility, if you look prior to that, even in the late 90s, you tend to have a lot more volatility in the market. So certainly we saw a sharp rise in the March and kind of hit an all-time high in terms of the VIX or the volatility index. But that has come down quite a bit, still a little above the long-term historical average, but back to kind of a normal market environment from that perspective. On the next page, just looking at the U.S. equity markets. So in the top bar charts, we highlight the various sectors of the S&P 500, and then below is just what the returns are for different market caps and different styles, so value, core, or growth. So if you just look in the bottom right-hand side, the year-to-date box, the story has really been growth, has really been a factor that has really led the market. And what this translates to in the top bar charts is some of the sectors that have done the best this year. Information technology, which was actually positive through April. Consumer discretionary and healthcare tend to be some areas within the growth segment of the market that have really led. And it's really been a function of, there's not a lot of growth globally. So investors, have really focused on growth companies, which have been driving the market for quite some time. And outside the US on page 12, really a similar story. So this is looking at the Msci Ifa benchmark. So these are developed markets. You can see that it's a similar story in the bottom right. Again, it's really been a growth-led market really across the board. And again, some of the sectors that, haven't done as well as the US, but healthcare, consumer and information technology, again, have been some of the areas that have led the non-US markets. Maybe if we skip ahead to 14 and talk about fixed income. So the top bar or the top lines really show you the treasury yield curve. So from kind of, the Fed funds rate at the far left all the way out to 30-year treasuries or government bonds. And really, if you kind of focus on, the dark blue line, that was April 30th of 2019, down to kind of the dark gray with where we were at the end of April. It's been a meaningful shift downward in yields across the board. So this has been, a headwind for a lot of investors. It impacted one of the managers in the portfolio pretty meaningfully. I don't think anybody would have expected rates to fall, as quickly as they did and across the curve. So in the bottom bar chart, what it's really led to, the only areas that have really done well this year have been high quality and longer duration securities. So those are going to be the government and long government bonds. Most active managers tend to be underweight a lot of the treasury areas. Those have been some of the more richly priced areas of the fixed income market, which has led a lot of active managers, to steer away from those. But in a time of crisis, that is really one of the only assets out there that is going to protect you from the volatility that we've seen. Fortunately, in April, you can see some of the bright blue boxes or bar charts below. A lot of the spread sectors, so mortgage-backed securities, investment-grade corporates, high yield, we've seen a strong recovery in some of those areas of the market, which has been favorable to several of the managers in the pools on the fixed income side. So with that, maybe we can jump ahead to page 20 and just dive into the pools. I know there are a lot of other slides on the markets that we're happy to address, but this is just data through April for the underlying managers across the pools. So as we mentioned earlier, in the domestic equity, we have the Christian Brothers Core Equity Index Fund. So this is a passive vehicle that is Catholic, socially screened. So that usually is going to tend to track the S&P, pretty closely. And again, this is another one where, there's a $3 million minimum for this vehicle. Fortunately, just with the size of the foundation, being able to offer that to all investors is, a great enhancement there. On the non-US side, we have two managers in the portfolio. One is Dodge & Cox. I'm sure a name, most of you are familiar with, out in San Francisco. They are a value bias manager. So having a value strategy has been a headwind really for the past couple years. They're also a little bit of a deeper value manager. So what we mean by that is they're going to find companies that are trading at more of a discount, either versus their history or versus peers. So one thing that's impacted them this year has been an overweight to financials, and particularly in emerging markets where they have some exposure. We spent a lot of time with Dodge & Cox. They've gone through cycles like this before, and they tend to come out of these pretty strongly. But as we think about the portfolio and the asset allocation and the structure that we have, we pair them with a more conservative growth manager, which is Harding Loevner. So instead of having a very aggressive growth manager that's going to have a lot of volatility, we're with more of a kind of reasonable growth manager, which you can see in the year-to-date column through April, had really protected capital versus the benchmark and was really ahead, over all time period. So again, we focus on individual managers, but we also take a step back and focus on the broader asset allocation of the pools as well, and how all these pieces fit together. The last two managers I'll comment on fixed income. Dodge & Cox, a core manager within the fixed income space. And then Western Asset, a well-known bond manager out in Pasadena, California. So this is an unconstrained strategy. So what we mean by that is that from a duration perspective, they have a wide degree of flexibility. Also in terms of sectors, they have a wide degree of flexibility as well. So it's really kind of a benchmark agnostic approach. So you'll see they were down, they're down about 5.8% this year. Really, it's been two areas that have impacted them. One has been a negative duration. They're actually at about a zero duration today, but as rates come down, you want to have a longer duration because prices go up. So having a shorter duration really impacted them, and also where they have found value and continue to find value is in a lot of the credit areas of the market. So investment grade, high yield, outside the U.S. So that has impacted them significantly. Again, we saw a pretty sharp recovery in April. And over time, they've had a very good track record within this strategy, but in a period of sharp volatility, is one that can underperform. So we have, more detailed pages on each of the managers that we won't run into, but hopefully that'll be helpful. What we wanted to just kind of talk about right here, page 26, as we mentioned earlier, really having, a steady hand, maintaining a strategic asset allocation, we think is critical. And hopefully this chart tries to show that. So this is the S&P return going back from March of 1970. To the end of the first quarter of this year, and really the actual return, the S&P has returned 10.2%. This just shows you what your return would have been if you're out of the market for the top 10 days, the top 20 days in orange, and then the top 40 days in blue. So again, the story is nobody can time the market. We like to think we're smart, but we know we're not smarter than the market. So again, just kind of maintaining that strategic approach is critical. Really to maintain fully invested, really serves investors well long-term. And that kind of gets maybe just to the last slide, and then we'll kind of wrap things up and open it up to questions. we get the question from a lot of clients, as Brian mentioned, we have, 90 institutional clients. So when they ask questions like this, a couple of the answers are, again, remain patient. We know these periods will work out. They can be challenging at time, but again, keeping your strategic asset allocation, as you saw on the previous slide, really benefits investors over the long term. In terms of cash needs, again, we know each organization or individual is very different. So as we think about it, and as underlying companies think about it, make sure you have enough cash to meet spending needs, expenses, whatever it may be for the next several months, just so you're not having to sell from equities when the market's down significantly. So again, not trying to say you should be out of the market, but again, have a couple months buffer there in terms of cash. And then lastly is just rebalancing. Again, back to targets, as we saw earlier, all of the pools have targets. They tend not to drift too far from targets over time, but if it is a situation where you're significantly underweight equities and overweight fixed income, given that equities sold off, what clients have done is just, incrementally add back to, equities over time, not do it in, one day, because as everyone knows, there's a lot of volatility out there. So you almost kind of dollar cost average back over, several weeks, several months to get back to target. And fortunately, the markets have recovered quite a bit. So it's done a lot of the rebalancing for clients, in general so far. So hopefully that was helpful. Maybe we pause it there. And Matt, I don't know if anything else you wanted to comment on.
No, gentlemen, thank you. I mean, I know that's a pretty high level for folks because we have people on the line here that are in the midst of building churches, and they don't know if in the next 2 years are going to be starting or completing their projects and so forth. We have individual fund holders that are looking at what are they going to do from their strategy of when they intend to grant money out of the foundation and so forth. So I haven't seen any chat questions, but I would think we should open it up for questions at this time. So if you have a question, and there may be several of you, so if we end up talking over each other, if you could just be patient with it, please. But go ahead and unmute and please ask your question.
I'll ask one if you can hear me. How many of your investment managers have you replaced in the last 10 years?
In the last 10 years?
Yeah, 5, 10. What's your turnover on managers?
It's pretty low. If I had to guess a percentage, maybe 20% at most. The key for evaluating, use Dodge and Cox as an example here on page 20 where we were talking before. This endpoint, when you look at their performance, it doesn't look very good, right? As of April 30th, it looks pretty bad all the way out to the 5 years. That wouldn't necessarily concern us, although it would cause us to look deeper, obviously, into what's going on. The slides that Taylor took us through that showed the growth value disparity, which we just looked at this year, the issue's been for 9 years, basically, has made it so that they should have underperformed in this time period. Things like that don't bother us as much as long as it's understandable and explainable and it follows the strategy that the manager has in place. The things that would have caused us to switch a manager over time would have been organizational changes, whether it's portfolio managers retiring or leaving, or firms being bought and it didn't suit the product, or the underperformance that you have is not explainable, doesn't make sense given their strategy. That kind of thing would cause us to replace managers. So that happens from time to time, and we've had it within the Catholic Foundation portfolios as well. But typically, if there's underperformance, patience is usually the best way to go about it. But a broad guess, I'd say 10 to 20%.
Do we have any
I'll
other
make
questions?
one more comment then. Your timing chart or slide about the, yeah, that one. I would love to see one that says what happens if you miss the 10 worst, 30 worst, 50 worst days in a period. Everybody takes the best. Just by numbers, you just take it. That actually shows that timing is bad, but I'll bet you if you averaged them out, it doesn't look anywhere near as bad as that. And if you took the worst days, you might have some people making an awful lot of money. I'm not saying you can time it, but this is biased in one direction when you show that. It'd be interesting to see the opposite side of that chart.
Yeah, and the hard thing to do, which you kind of mentioned it, is you have to be right both ways.
Yep.
And so you're right. If you showed it the other way, it would show a totally different story.
Sorry.
All right, are there any other questions that folks have?
This is Mark Lyons. I just add that that's one of the things that just emphasizes the long-term strategy of the investment policy of the foundation, that we're doing everything we can not to be in a position where we're trying to pick a high or a low, but that it's a long-term strategy.
Well, Taylor and Brian, we appreciate you spending time with us today to go through this. I know that people may have some questions after this, and if they do, you please reach out to us and we'll be happy to get the answers from LCG to your specific questions for your specific needs. But we appreciate everybody for attending today, and we wish that you stay safe and healthy. All right. Thank you so much.
Thanks, Matt.
Well done.